Gold just did something that in calmer years, people would have called impossible. 10 after tagging the mid-5000s. Silver didn't just fall, it snapped. 96. Those moves are not routine volatility. They are stress fractures in the market's plumbing. And here is the uncomfortable reality. When moves like this happen, the public learns the story in reverse. First comes the price shock, then comes the explanation. But the institutions that dominate these markets don't wait for explanations. They watch the mechanisms that force buying and selling. They watch margin tables, collateral calls, index flow calendars, and positioning reports. They know where the market becomes fragile, long before most people even realize fragility exists. They said gold was the steady one, the ballast. And yet, it just did, with speed that compresses time and scrambles confidence. That's your pattern interrupt right there. Because once you see a supposedly stable market move like a meme stock, it forces one question. What's really setting the price? This is the part no one is discussing clearly. This wasn't a spontaneous, global change of mind that happened in perfect unison. It was a collision between leverage, liquidity, and rules. And the rules matter more than opinions when volatility explodes. What I'm about to reveal changes how this whole episode looks. It isn't about a secret cabal, and it isn't about one villain pushing a button. The data shows how it happened, why it keeps happening, and what to watch next. Welcome to Vault Signals, where we decode market mechanics before they become the headline everyone repeats. If you value calm forensic analysis, filings, margin changes, positioning, and flow, consider subscribing the way you'd keep listening to a wise elder who's seen this movie before. And tell me where you're watching from in the comments, because these patterns show up differently depending on where you sit in the world. Now let's reconstruct the event, the way a desk would, not the way a talking head would. Into late January 2026, precious metals were coming off a powerful run. The atmosphere around gold had become almost one-directional. Inflation anxiety, currency debasement narratives, geopolitical risk, and the psychological magnet of new highs. Silver, as it often does, followed with extra torque because it is thinner, more volatile, and more easily pushed by leverage. Then the market turned, and it didn't turn politely. The timing also mattered. The break wasn't spread across a month where the market could digest information. It was concentrated into a couple of sessions where liquidity can be surprisingly thin at key moments. When a market is extended, even a modest shift in expectations can be enough to tip the first domino. Once that first domino falls, the market stops trading the headline and starts trading its own risk limits. That is why a move can feel disconnected from the daily news cycle. The price is not debating value, it is clearing risk. In practice, this shows up as gaps and air pockets. Instead of a smooth series of trades, price jumps from level to level as bids pull away. Liquidity providers widen spreads to protect themselves. Options market makers hedge more aggressively as volatility rises. And every one of those actions is rational on its own, but together they create a market where the next print can be dramatically lower than the last. Gold didn't drift down on light volume. It fell in steps that looked like floors giving way. Each break triggered a new wave of selling. Stops fired. Liquidity thinned. Spreads widened. At the same time, silver experienced what only happens when a leveraged market hits a liquidity vacuum, an air pocket. A 27% one-day drop is the footprint of forced liquidation, not a slow reassessment of mining supply. 96 suggests the first wave didn't fully clear the system. Here's the abnormality that matters. In a normal correction, you see orderly two-sided trade. Buyers step in. Sellers meet them. Price falls, but the market breathes. In this episode, the breathing stopped. The market behaved like it had to transact, right now, at whatever price would print. That's the signature of the marginal seller being forced. And that's why the central mystery appears. The broader reasons people had been bullish didn't evaporate in 48 hours. Mining output didn't jump overnight. The world didn't become perfectly stable. Monetary systems didn't suddenly regain universal trust. Yet price behaved as if the entire bullish thesis had been deleted. That contradiction is the clue. It tells you the driver wasn't a new long-term belief. It was a short-term constraint. And in futures-driven markets, the tightest short-term constraint is almost always collateral. If you want to understand today, you don't start by guessing motives. You start by finding the historical rhymes. In 1980, silver experienced one of the most famous boom and bust episodes in modern commodity history. The details included concentrated positioning and intense leverage. The turning point was when the financing conditions changed and the system demanded more collateral. The result was a crash that arrived faster than most participants could adapt. In 2011, silver provided a cleaner, modern example of the same playbook. It surged into the spring as momentum built and participation widened. Then, exchanges raised margin requirements repeatedly in a short span. The official logic was risk control. The market effect was forced deleveraging. Price collapsed, not because every participant suddenly became bearish, but because many participants could no longer afford to stay long at the new margin levels. The story didn't need to change. The carrying cost changed. In 2013, gold delivered another lesson in market structure. Large flows hit paper markets, including futures and ETFs. Liquidity fractured, stops cascaded. Again, the mechanism wasn't a slow shift in jewelry demand, it was a rapid shift in flows and positioning, amplified by leverage and liquidity. Even March 2020 fits the pattern. During a global liquidity scramble, gold sold off alongside risk assets for a time because the immediate demand for cash was overwhelming. It wasn't that gold stopped being a hedge in the long run, it was that margin calls and cash needs forced sales in what could be sold immediately. The common thread across these episodes is simple. When leverage is high and liquidity is fragile, a change in collateral requirements or a concentrated flow window can turn a market from stable to unstable in a day. That's the hidden pattern. And it's exactly the pattern January 2026 just printed again. So who was moving, and how can you tell it was structural instead of emotional? Start with the exchange, because the exchange is where the rules become executable. CME sits at the center of U.S. precious metals futures. When CME changes margin requirements, it changes the cost of holding risk for a massive portion of the market. After the historic plunge, CME raised the initial margin requirement for gold futures in the non-heightened risk category from 6% to 8%. For silver, it raised the comparable requirement from 11% to 15%. And for accounts designated heightened risk, the required margin steps higher than those baseline tiers. That's not a commentary, that's a cash demand. Put those percentages into plain math. Moving gold's initial margin from 6% to 8% is not a tiny tweak. It is about a 1/3 increase in the cash required to carry the same notional exposure. For silver, moving from 11% to 15% is roughly a 36% jump in required collateral. And that's before any broker adds house margin on top. If a trader is controlling $10 million of notional gold exposure, a 6% requirement implies about $600,000 in margin. An 8% requirement implies about $800,000. That extra $200,000 has to come from somewhere, immediately, while prices are falling. This is why margin policy can change who survives a sell-off and who becomes the sell-off. Now translate that into behavior. If a fund is running leverage, it is effectively renting exposure. Margin is the down payment on that rental. When the down payment increases abruptly, the fund either posts more cash or reduces the position. There is no third option that preserves both the same position size and the same cash level. So when a margin hike arrives during a fast sell-off, it doesn't just reflect volatility. It accelerates volatility by forcing liquidation into weakness. Next, consider the clearing firms and prime brokers. They sit between traders and the exchange. When volatility spikes, they often apply their own house margins on top of exchange requirements, especially for clients with concentrated or directional exposure. That double tightening matters because traders don't just meet CME's requirement, they must meet their broker's requirement. When both tighten at once, the system demands cash on multiple fronts. Then you have the large, rule-based flows that don't care about opinions. Commodity index products track published weights. When weights change, funds that track those indices must rebalance. Banks facilitate those flows, often by positioning ahead of the rebalance window to reduce market impact. $7 billion of gold futures selling. Whether a number lands exactly there or not, the key point holds. There are periods when large rule-based flows sell because the calendar says so, not because the underlying story changed. Now, layer in the speculative community, visible through positioning data. 4,000. 4,000 in net speculative length in a single week. In a normal market, positioning changes are gradual. And there, it's another player that doesn't have a logo but shapes outcomes, risk management itself. Risk models respond to volatility. VAR limits tighten, leverage allowances shrink, correlation assumptions shift, portfolio constraints become binding. When multiple funds receive the same volatility shock, their risk models often point them toward the same action, cut exposure. That synchronized risk response creates coordinated selling without anyone coordinating. It is coordination by math. Finally, there's the regional participation effect that can amplify swings. When speculative activity surges in a particular region, often cited in this episode as China-linked participation, it can increase the reflexivity of price. Reflexivity means price rising attracts more participation, which pushes price higher, which attracts more participation. The downside version is brutal, price falling. Triggers forced selling, which pushes price lower, which triggers more forced selling. If that reflexive market hits a period of thinner liquidity, the same size sell order can produce a much larger move. Put all those players together, exchange rules, broker constraints, index rebalancing, speculative positioning, volatility-based risk cuts, and regional reflexivity, and the hidden hands become visible. Not hidden because they're secret, but hidden because most commentary never looks at them. Now we get to the dislocation, the part where two sets of signals appear to tell opposite stories. In precious metals, the benchmark price is often set in futures. Futures are fast, liquid, and leveraged. They are designed for price discovery, but that price discovery happens at the margin, driven by the most urgent orders. Physical markets move differently. Physical metal must be fabricated, shipped, insured, stored, and financed. Physical buyers and sellers often operate on longer time horizons and different constraints. In a leverage-driven smash, paper markets can collapse even while physical behavior doesn't instantly mirror the panic. That creates a gap between what the screen says and what the supply chain feels. It means they are responding to different forces on different timelines. Here's a simple way to visualize it. Imagine a crowded theater with one narrow exit. The people near the exit are the futures traders facing margin calls. They must move now. The people in the back are the longer-term holders and physical participants. They may not move at all in the first wave. The panic at the door can look like the entire theater is on fire, even if most people haven't even smelled smoke. The exit bottleneck sets the immediate motion. That bottleneck in this episode was margin and collateral. When gold fell roughly $1,000 in 48 hours, it didn't just hurt sentiment. It forced balance sheet decisions. Every dollar down increases variation margin. Variation margin is cash paid daily to cover losses on futures positions. When the market moves fast, that daily cash demand becomes enormous. Add a margin hike on top, and the cash demand spikes again. The result is a seller that sells because it must meet a cash obligation, not because it has a new view on the world. Meanwhile, other signals can lag, and that's where the dislocation lives. Consider how quickly narratives can change versus how quickly physical supply chains can adjust. A futures contract can be sold in milliseconds. A shipment of metal can't. A vault allocation can be rebooked, but physical movement takes time. In the short run, paper can move far away from the slower-moving physical reality. This is why dislocations often show up as two markets telling opposite stories. Over time, one of those stories must converge. Either physical demand fails to absorb and the paper price stays low, or physical demand and longer horizon flows absorb supply, and the paper price rebounds once the forced sellers finish. Historically, the moment of convergence is visible in measurable conditions. 1. Volatility. If volatility compresses after the smash, it indicates the forced liquidation wave is ending. 2. Margin policy. If margins stabilize instead of ratcheting higher, it indicates the exchange believes risk is becoming manageable. 3. Open interest and positioning. If open interest stops collapsing and speculative net length stops falling, it suggests the market has cleared the most fragile leverage. 4. Liquidity. If bid depth returns and spreads narrow, it indicates the market can absorb flow again. This is not philosophical, it's mechanical. A dislocation cannot persist indefinitely because the market's structure forces reconciliation. The only question is which side of the story wins the reconciliation. So how, exactly, does a smash get executed without anyone needing a grand plan? Start with leverage, because leverage is the amplifier. A futures contract lets a participant control a large notional position with a smaller amount of cash. That efficiency is why futures exist. But it also creates fragility because the system monitors your cash relative to your exposure. When price moves against you, the system demands more cash. When volatility rises, the system demands more cash even if price is flat because the risk of further movement is higher. Now add the feedback loop. As price begins to fall, stop orders trigger. Stops are often placed just below obvious levels. When those levels break, stops become market orders. Market orders demand immediate execution, which pushes price lower in a thin book. Lower price increases realized volatility. Higher volatility triggers risk models and margin adjustments. Higher margins increase cash requirements. Higher cash requirements force liquidation by the most leveraged players. That liquidation pushes price lower, triggering the next ring of stops. This is why it can feel like price is being hit again and again. In reality, the market is digesting a chain of forced transactions. Now bring in the mechanical flow component. If index-linked selling is scheduled in a window, liquidity providers anticipate it. Some hedge, some step back, some widen spreads. That anticipation alone can make the market more fragile. And if scheduled selling arrives into a market already weakened by stop cascades and margin pressures, the impact multiplies. Not because someone wants chaos, but because the market's ability to absorb flow is reduced. Finally, consider the psychological layer that rides on top of mechanics. After an extreme move, discretionary traders often react. Some buy the dip, some panic sell, some de-risk because they can't explain what's happening. That discretionary layer is not the primary engine, but it can add fuel to the mechanical engine. The crucial insight is that the first wave of a smash is usually mechanical. The second wave can become emotional because people respond to the mechanical damage. Once you see the chain, the episode becomes legible. Margin hikes and variation margin calls are not footnotes. They are the transmission mechanism from volatility to forced selling. And forced selling is what creates the kind of numbers we just witnessed in gold and silver. So what does this mean from here without turning analysis into prophecy? Historically, after a leverage-driven smash, markets enter a phase where the next move is determined by whether forced selling has truly ended and whether liquidity returns. That's why the most honest approach is scenario analysis based on conditions, not predictions based on feelings. If volatility compresses and margins stabilize, history often shows a basing process. Price may remain choppy, but the violent liquidation phase ends. In that environment, the market starts trading on new information again instead of trading on forced exits. If volatility remains elevated and margin requirements continue to ratchet, history often shows a second wave. That can happen because some participants survive the first hit, but the next cash demand finishes them. Secondary waves are common when the market initially bounces and convinces late buyers to step in before the deleveraging is complete. If broader financial conditions tighten sharply, history sometimes shows a deeper repricing. That's the scenario where the smash is not just a position reset, but part of a larger risk-off cascade. In that case, the key is not a story about metals. It's a story about liquidity, funding markets, and what gets sold to raise cash. So what should be watched? 4,000. When those metrics stabilize, the market's foundation is rebuilding. When they keep deteriorating, the stress is still active. One more tell. After a smash, watch for the moment selling no longer pushes price lower. When heavy volume hits and price holds, it signals absorption. When the same size sell orders keep creating new lows, the liquidation machine is still running in real time. This is where the divide opens up between two kinds of market participants. One group experiences the smash as chaos and searches for a single villain or a single headline to blame. The other group experiences it as structure and looks for the constraints that forced transactions. The difference isn't genius, it's what gets measured. Institutions move first because their job is to monitor the machinery. They track when index flows are due. They map where leverage sits. They see margin changes as immediate catalysts, not as boring footnotes. Retail moves last because retail sees price first and mechanics later. That information gap becomes a wealth gap because being late in a forced liquidation event is expensive. The lesson of this episode is that markets are not only driven by beliefs, they are driven by rules, by funding, and by liquidity. When those tighten, price can do impossible things, even in gold. So when you hear gold got smashed, translate it into the language the market actually speaks. Leverage met volatility, volatility met margin, margin met forced selling, and forced selling met thin liquidity. Those are the hidden hands at work. This is Vault Signals, where we decode what matters before it becomes the headline. If this connected dots you hadn't connected, you know what to do. Because the question isn't whether precious metals will be volatile again. The question is whether the next time the machinery shifts, the mechanics will be visible before the price makes it obvious.